In terms of the tone that we got from Biden about China, was that what you were expecting? Do you think that he struck the right balance between saying that we can work with them, but also suggesting that, if we have to bare our teeth, we will?
I think the focus on competition is consistent with the message that the Biden administration has tried to push over the course of the last couple of months. Clearly, markets have been looking for a thawing in the relationship between the United States and China. And so I think the commentary that we're getting is very consistent. I think the question moving forward is, in a divided Congress, going into a very important election year, how stable is that commentary as we go into the next 12 months?
Dan, I just wanted to go to you now because obviously so much is made of the inflation pressure to the downside and all the work that the Biden administration is doing. But as it relates to oil prices, we know of the ongoing conflict in the Ukraine. What can we expect in your mind from the Biden administration moving forward? More SPR releases, or are they going to be helped along by the fact that oil right now is far lower than it was earlier on this year or last year?
Yeah, sure. Well, I think we're likely to see, as we look ahead, oil prices are probably closer to their lows than their highs for the next 12 months. I think that the Biden administration probably doesn't have a lot of ammo left in terms of SPR. It was a big release in 22. I don't think we'll see nearly as much oil brought to the market in 23. And so some of the weapons that we had for combating energy inflation in 22 probably aren't there in 23. So my expectation is that as we move ahead thinking about inflation, energy is going to be at least one of the sticky points as we fight this battle between potential for lower rates and disinflation versus potentially stagflation.
I think there's maybe two comments that I would just add to the overall commodity outlook and energy in particular. Number one, our expectation is that the economic recovery in China will be primarily consumer-led, not manufacturing-led. That is very different from previous history and drives significant less incremental demand in the commodity space than one might otherwise expect. I'd also highlight the statistic that gasoline demand out of the U.S. has actually fallen for the past 2 years and is currently sitting at levels significantly below 2019 because of electrification as well as efficiency gains. The U.S., representing 36% of global gasoline demand and the largest consumer in the world, is an incremental driver. If that starts to fall back, I think that the outlook in the commodity space has to be somewhat sanguine off the back of those two statistics.
On that, would you be positioning within the energy space right now, or is it too rich for your blood?
No, for us, I mean, obviously it was a fantastic sector last year. We're still invested in the energy space. I mean, we in large part agree with Dan. Oil prices for the year are probably closer to the low than they are to the top. But given that, our exposure within the sector tends to be quite defensive and quite conservative. So we aren't very far out on the risk curve with exploration companies, for example. But we do own a small handful of oil majors that are trading at extremely low valuations, are cash generative, even at lower oil prices than where they are today. So we think that certainly over our investment horizon, I mean, through a full investment cycle, it's still a sound place to allocate capital.
Now, just finally, just in terms of, because I believe we can all agree that it wasn't anything that was going to be a major catalyst coming from the State of the Union. So in both you gentlemen's mind, I'll start with James, just in terms of what your expectations are, especially as it relates or pertains to the Fed, because you alluded to that earlier, but we've seen a rapid shifting of the market pricing in terms of the front run.
So the general rule of thumb is that presidents get both too much credit as well as too much blame for the overall state of the economy, and I think that's the case here. In a divided Congress, I would agree that we're unlikely to see major policy shifts over the course of the next 12 months, in which case we go back to the underlying economic fundamentals. The U.S. is running better than expected, which means the Fed will likely stay strong longer than expected, which will have knock-on for global markets. The critical elements from our perspective are, number one, the Chinese recovery will be very different this time around than before. We've seen a significant inflection in Chinese asset prices over the course of the last couple of months, primarily from an Asia perspective, out of India into China. I do think we're going to look to see that trade start to reverse out as we get into the second half. As positioning has started to square in China, people are not nearly as underweight as they used to be. And you start to see a greater recognition that long-term economic growth in China is a much longer conversation.
Just for you, China?
Yeah, I mean, we share the same view as James, both from a rate standpoint, given the strength of the U.S. economy currently. Rates are going to need to either go higher than the market's currently priced in or stay there for longer than investors are expecting. I mean, given that in our opinion, U.S. markets are quite expensive, and there is more value, particularly for the growth you're getting in Asia, and in particular in China.